Welcome to Business Talk here on Business Tech, South Africa's #1 business news website with well over 3 million visitors monthly. And we're getting close to the end of the tax year. There's been a lot of talk about retirement annuities and tax-free savings accounts in the media. So today we've invited Mariska Comins in studio just to answer some questions around what retirement products are out there and how we can actually outsmart the tax man a little. Mariska is the head of technical advisory services for PSG. Mariska, great to have you on the show. Given the political instability in South Africa currently, we've just recently had the State of the Nation, and we could see how fractious that was with the EFF storming out, and the fact that there's this negative perception around retirement vehicles. Do you still think there's a place for a traditional retirement annuity in a client's portfolio?
Hi, Michael, and thank you for having me on the show. Yes, so with regards to political instability, it will always create uncertainty, and it will continue to do so. I don't think we're ever just going to walk away from it. And we also need to be realistic that unforeseen circumstances will challenge us in our lifetime. I think it's very important that we try and remove ourselves from all the news in the media and the negativity, and that we focus on what we want to achieve with a product like a retirement annuity. And that is ultimately to retire comfortably. So is there a place still for a traditional retirement annuity? Absolutely, yes, I believe there is. And we need to look at it in a little bit broader way. So if you look at the tax deduction that you can get through investing into a retirement annuity, and not only the tax deduction benefit, but also the growth within the product that is tax-free up until retirement. So absolutely, there are benefits, but just bear in mind that a retirement annuity is not the only product that you can invest in for retirement. But it's good to always strike a balance and to use those benefits in your retirement planning.
I certainly think one of the big advantages has got to be around the tax benefits in terms of the way you structure your overall financial plan. And as you said, there isn't just the RA that provides tax benefits. You've got tax-free investment products as well. Are there any advantages in opening these tax-free investment products for children or grandchildren even?
Yes, absolutely. I think that is one of the best gifts that a parent or grandparents can give a child, bearing in mind that there is no age limitation and that every investor has the ability to invest up to 36,000 Rand per annum, max 500,000 per lifetime. So for a parent to contribute in a consistent way, or a grandparent in a consistent way over a child's lifetime, you can really add value by contributing to probably tertiary education, maybe a deposit on a first home, or even maybe buying that child a car on his 18th birthday. So absolutely, definitely beneficial. And bearing in mind that is also that the growth within that product is tax-free. So absolutely a yes to that one.
Absolutely. And the thing is, you're getting that compounding effect, the eighth wonder of the world, as it's called, over the duration of the child's life. If you start putting away from their first birthday, 18 years, if you're going to give it to them at their 18th, or 21 years, if you're going to give it to them when they turn 21, the power of that compounding, I think, is hugely, hugely powerful. Now, there are obviously advantages of investing in an RA, but there are limits. There are prudential limits around Regulation 28, that exposure in different asset class different asset classes can't really exceed different limits. How does this impact your retirement plan and your financial planning in the long term? Because I think a lot of people hear limits and they think, oh, I want freedom just to put 100% offshore, for example.
Yeah, so definitely, I think last year, February, the Regulation 28 limitations that is applicable to retirement products, that was adjusted. Previously, collective investment scheme fund managers could only invest up to 30% into offshore asset classes or have offshore exposure, and that was increased up to 45%. So we've seen quite a drastic move by fund managers enjoying and using the offshore exposure. So although there are limitations, there's also some more flexibility, especially on the offshore aspect since last year. So definitely enjoying a little bit more on the offshore, less South African exposure. So direct offshore, if you still want to look at a direct offshore investment, definitely other products, consult one of your financial advisors or a financial advisor to ask about other alternatives. But within a retirement annuity, you will have that limitation, but to a lesser extent.
I do think the limits are there because they make good common sense in a well-diversified portfolio. You should never have 100% concentration in any single asset class or geography in any event. So they really are well thought through, those Reg 28 limits, and great to see that offshore component, because South Africa, let's face it, is less than 1% of the total investable universe, has been raised. What do you see as the most common or some of the biggest pitfalls to retirement planning? Because the one stat that always jumps out year after year is the fact that roughly 6% of South Africans will eventually retire with whatever is enough for them. I mean, it's a pitifully low number. What are the big challenges?
So there are many challenges, and I think we can actually have a whole day debate on it. But the key challenges for me, or pitfalls, is miscalculation of your true expenses and your lifetime expectancy. So often clients do not sit down and do a proper budget. They don't understand all their expenses. And there's really this miscalculation of what income you would require when you retire. Now, there is a guideline to say between 70 and 80% of your current earnings is what you will need at retirement. But I think it's absolutely important to bear in mind that you need to, at a minimum, outperform inflation. But you have other expenses like health expenses that is more than inflation, and you need to factor that into a projection when you want to retire comfortably without sacrificing too much during your retirement. The second one is not having enough liquidity at retirement. So you actually fall into a cash trap. So very important, as I mentioned earlier, that you consult an advisor to find that balance of investing into voluntary investment products and into retirement products, because often a retirement or preservation, provident, pension fund is a large component of your assets, especially if you contribute through an employer. That could become a huge component. Then thirdly, investing too conservatively over the long-term horizon. It's a natural thing that we want to safeguard our assets, that we don't want to lose money, but you also need to bear in mind that investing too conservatively over the long term will erode your capital, because you need to at least outperform inflation. And with asset classes like cash, you can definitely fall within that pitfall. And then the last one is cashing in retirement funds when you change employers. So it's very lucrative to think you can make a withdrawal and you can enjoy that money whether you settle debt or maybe go on a holiday. Like you mentioned earlier, that compounding interest effect, losing that is detrimental. And I mean, that could cost you a couple of years' income at retirement.
Yeah, and all of those, when they compound over time, can make the biggest difference when it comes to retirement. Inflation, and you mentioned that, I think now more than ever is going to become the boogeyman for investors, because we have seen all over the world, not so much here in South Africa. Inflation is high, but it's not at 4 decades high like it is in the US. But it's increasingly becoming this conversation that investors, that retirement savers, those approaching retirement or those still with many years to save till retirement are going to have to deal with, because everything's becoming more expensive. Is it still a smart idea then to invest in a product that has limited accessibility in the short term, like an RA, for example, or should we be thinking a little bit more tactically around having reserve funds tucked under the mattress?
So reserve funds under the mattress always sounds like a good idea, but the accessibility to it is maybe a bigger challenge in spending it. But yeah, to be honest with you, I do think that there are still advantages. If we look at the tax saving aspect that we referred to earlier, the tax-free growth in the product, investment products or retirement products rather is largely protected by creditors. So you have the benefit of making sure that you look after your financial dependents and yourself during retirement. So creditors can't easily access those funds. And then retirement funds do not form part of your estate. So just remember that retirement funds, there are trustees that looks after those funds. Their responsibility is to make sure that if you pass away, that your financial dependents are looked after. And I think that also creates a little bit of peace of mind if you take that into consideration.
Well, I think if you don't have, I've got an RA, I've got tax-free savings products I've got for my children. You've got to be taking advantage of all of those benefits because there are very few free lunches in investing, but certainly the tax breaks that you get, they are absolutely guaranteed, regardless of which way the markets go, and that we know they've been volatile. Mariska Comins, thank you very much. Head Technical Advisory Services for PSG, talking a little bit more about how you should be thinking about your retirement planning and vehicles like retirement annuities and tax-free investment products here on Business Talk.
Thanks, Michael.